Hey, Dan Fitzpatrick here, stockmarketmentor.com, and I want to just show you something real quick. I don't have a lot to say. A lot of stuff being said, I'm just not one of them anymore. But with Zoom, one of the things I pointed out yesterday on Thursday in our strategy session for members was how to kind of turn back time, so to speak, and put yourself in a position to buy stock where you wish you had, but you didn't. And so I'll use this. One of the examples I used was Zoom video. So on Thursday, the April 130 puts were trading at 860. Now, a put option, if you don't know what those are, most people don't, is a put option is something that if you sell the put option, you can sell the April 130 put. Not anymore. But at that time, you could sell the April 130 put for $8.60. And that applies to 100 shares of stock, meaning that you get $860 if you sell one put. And in return, the obligation that you incur after you have sold one put for $8.60 multiplied by 100 for each share is $860. The obligation that you have is that between now and the third Friday in April, which is April 17th, somebody can make you buy the stock at $130. That's called a put option. You have the stock put to you. You've taken in $8.60, and in return, you can be forced to buy the stock at $130. Now, I would love to be forced to buy the stock at $130 because here right now the stock's trading at 140. Okay, so that's not going to happen, right? But the idea is that you didn't buy it here on the breakout, or maybe you wish you'd have bought it at 120. So you obligate yourself to buy the stock at 120. But this was a trade that I actually suggested on this day. Okay, so let's see how this played out because this is important. So this is a chart for Thursday. Then today, the stock's up another 7%. So you could have bought the stock. Fine, don't sell the put. Just buy the stock and make money here this way. And that would have been certainly a profitable trade. Bought it at 140. Now it's at 150. That's $10. That's good. But that's not the trade that I was talking about. And also, what would have happened if the stock, you're buying it here and the stock had fallen to 130 or something? Well, that would have been a bummer because you're taking a loss. But if you're buying the put, pardon me, I don't want to confuse you. If you are selling the put, the $130 put, this move today in the stock changed the price on that put option from the $860. Okay, now it is trading at $6.50. And so you've essentially made $2, which is, by the way, 25% of the maximum here, but I'm not calculating it that way. You've made basically $250. We'll round a little bit. You've made $250 by doing nothing other than obligating yourself to buy the stock at a price that you would love to buy it at. And so this is a way, just selling put options. And I'm not trying to goad you into being a put seller. I'm just giving you something to think about. If you learn how to sell put options, you literally can kind of turn back the hands of time and go back and do something that you wished you'd have done before. And, you can do stuff like this. You can look out and say, well, I think we're going to have a retest of the lows. But you know what? Hey, I'll go ahead and sell, the SPY bottomed here at 220. And so if the SPY gets back there, if it gets back there to 220, then I'll go ahead and buy that. Okay, so you know what you can do? Right now, literally, the May 220 puts on the SPY, and those options expire in the middle of May, May 15th. The 220 puts are trading for, we'll round up slightly, $10. So you can obligate yourself right now when this is SPY is trading at 254, you can obligate yourself to buy the SPY at a 13% discount to where it is right now at $220, and you get $10 for your trouble. So you're basically obligating yourself to buy, like right here, on May 15th, but your cost basis is actually going to be down at 210. It would actually be down about there because of the value you're getting. So you can be taking in money right now, making a bullish bet on the SPY. And, by the way, if the SPY doesn't fall down here, then you just keep that $10. And, what are you? You're out about a month and a half of money, of margin. So this is the type of way that, and you have to have, don't sell puts if you're not willing to take delivery. Don't just go sell a bunch of puts because your broker will let you. You sell 10 puts, 210 here. You can have 1,000 shares of SPY dumped into your account anytime you want. That's going to be a bad day if that's not what you're willing to do. So you have to have some kind of a control, some kind of risk management in doing this kind of stuff. But this is a strategy that you can use when implied volatility is so high. These options are really, really expensive. So think about that when you're sitting here looking around, waiting for your boat to come. And sorry, we won't make any cruise line things here, but waiting for your ship to come in on some kind of trade that's really not existing. Instead, kind of move forward, extrapolate, and say, what would I be willing to do in the future? And then go ahead and obligate yourself to do that and get paid for doing that. Okay? All right, members, I have a long one for you today. And that's it. It's not short.